Hello and welcome to the latest trades and tutorials video. This is Jeff Bish, president of MarketGauge.com. And in this video, I'm going to take a look at how you can identify the days that are likely to trend higher, as you can see here on the SPYs on a 5-minute chart, versus the days that are likely to be choppy. Now, with the Fed coming out with its latest interest rate decision tomorrow, this particular tactic could be very helpful in telling you which way the markets are going to move in the days following the announcement. It also may be very helpful to tell you what's going on right after the announcement. In fact, the more volatile the market gets, the more powerful this becomes in terms of identifying trend days. It also will tell you days in which you might be more inclined, or should be more inclined, to buy near the low of the day or sell near the high of the day. So before I get into the details, let me just make sure that if you're just finding us on YouTube, please subscribe to our channel and like this video. If you're finding this on Facebook, please like the video. And also know that you can find more videos like this on our website at marketgauge.com/tutorials. And we also put out lots of other trading insights and ideas on Twitter at Market Gauge and at Market Minute. Finally, if you're not already watching this in HD, change your settings in the lower right hand corner. It'll be a lot clearer. All right, so we're looking at the 4 major equity indexes as represented by the ETFs: the SPYs, the Qs, which is the NASDAQ 100, the Diamonds, which is the Dow, and IWM, which is the Russell 2000. And we're looking at a 5-minute chart really so you can see a good representation of how the day traded, and we can look at 4 different days. These just happen to be the last 4 days. I'm not cherry picking them, so let's just take it from here. You can see on the first day, the 15th, the SPYs had an explosive trend day up. Now, one of the ways you can figure out which way the market's likely to go is to use the first 30 minutes of the day to determine whether the bulls are in control or the bears are in control. We call it the 30-minute opening range. You can see those lines drawn on my chart. So the green line is the high of the first 30 minutes of the day, and the red line is the low of the first 30 minutes of the day. And you can see I have that on each day of the chart. You don't need to have this automatically drawn on your chart. You can pretty much see where it is just by looking at the time down below. Now, if you look at the opening range on one particular stock or one particular index, it will give you a good sense of the overall sentiment for the day. And that is that when the market trades clearly above the opening range high, the bulls are in control, which we saw on this day. And when the market trades clearly below the opening range low, the bears are in control. But oftentimes there's a lot of head fakes. And one of the ways to avoid those head fakes or trade with more confidence is to look at not one chart, but keep an eye on what the major indexes are all doing. And you want to see what they're doing relative to one another. In other words, are they all agreeing on which way the market's going to go? Now, if you look at it that way, and this is just one of the many tactics that you can apply very easily when all you need to know is the first 30 minutes of the day, high and low. On the 15th, you can see the SPYs broke out decisively over the first 30 minutes. So did the Diamonds. So did the Qs. And so did the IWMs. As a result, they all trended nicely higher for the day. Very clear signal. Now let's take a look at what happened the second day, on the 16th. In this case, it wasn't an up move. The SPYs started to move lower. But when the SPYs started to move lower, the Diamonds really didn't follow. And neither did the Qs, and certainly the IWMs did not. So in that environment, where if you were only looking at the SPYs and seeing them move down, you would have been thinking the market was actually in trouble. But if you're looking at all 4 markets, you would have realized that the SPYs really weren't pulling the market down, and there was a good chance that it was going to bounce, which in fact it did. It went all the way back up to the high of the day. But then once again, towards 2 o'clock, the SPYs were right back down near the low of the day, looking bearish. So were the Diamonds. But the Qs were not. Just barely breaking below their opening range low, and certainly not taking out the low from the morning, And the clincher was that IWMs didn't even get to their opening range low. So you had a major divergence there. And when you see something like that, you can easily look at what at that time was the strongest of these four indexes on a daily basis, turn back into its opening range, and go back up to the high of the day. So this is just one simple way to use this opening range concept. And I'll talk about numerous ways and more powerful ways in an upcoming webinar. I'll put that link above this video so that if you're interested in learning more, you can do that. But let's continue. Now the following day, the 19th, the markets gap up, try to run higher, but then look what happens when they take out the low of their opening range. And in this case, we have the Qs that breaks the low pretty decisively here. And the SPYs, not quite, but a little bit later at 12 o'clock, they do break it. So when the Qs are rallying back up, you can see the SPYs are breaking down. So when the Qs start to break down, if we look at the Qs, the diamonds, and the SPYs, they're all breaking down. We now have 3 out of the 4. We also have IWMs breaking down, even though they're not at their opening range low. We've got 3 out of the 4 below their opening range low. That's a big warning sign that you don't want to anticipate that this thing is going to bounce back into the opening range when they're all so decisively negative. So you've got a trend day when you've got 3 out of the 4 all going in the same direction, especially if the 4th is headed lower as well. Today, we see that the SPYs try to break but come back in. Diamonds try to break but come back in. Qs break a little bit, come back in. IWMs don't break, come back in. But once we get past 12 o'clock, they're now all trading under their opening range low. And that would indicate that until these markets get back over their opening range low, you really should be cautious. So all you have to do is understand the first 30 minutes has a very distinct effect on how the whole rest of the day could possibly trade. And you can make it even more powerful by looking at these 4 charts all at once. Again, this is one simple trick when you understand how powerful the opening range can be to make your trading a lot easier, be able to anticipate the way the market's going to go. I'll cover similar strategies to this in this upcoming webinar. So if this is of interest to you, please sign up. And I hope you'll find this helpful as the markets trade beyond the FOMC meeting later this week.